Well, Josh, another guest from the land down under here. Checkmate joins us from Australia. Needless to say, our predicaments are quite different. Our day's winding down. Your week's just firing up. It's literally like, what is it, 8 degrees outside? Wind chill might even be lower here, Josh, and he's kite surfing. So fuck you, Checkmate, because I wish we were in your location.
Yeah, well, I mean, look, there's a trade-off because the Football World Cup is on at 2 a.m. So, that's just not happening. So it's a trade-off.
Hey, by the way, this is going to get out with the exact day we're recording this. Do not say a word on the World Cup. Here's what happened today. I woke up. My wife was like, we're going to church. We're doing the Christmas Carol church thing. So recorded the World Cup, came home, watched the first half, second half. Second half just ended with where I'm at in this recording, and that don't you dare tell me what happened, because what a game so far.
On that note, so being the poor bugger here in Australia, I missed pretty much all the games, right? The only ones you could see is 9 p.m. and 6 a.m. during the early rounds, none of the finals. And the problem is every time you go to a streaming service so I can go and watch it, the bloody tile is the score. So you go there to watch the game and they give it away the second you try to watch it. It just stinks.
Shame.
Oh, trying to record this stuff and watch it later is treacherous. It's like trying to tiptoe around lava. Like, I'm sitting at church, like, who's maybe watching the game? I can't listen to that person. When do I need to plug the ears? It's a game of hot potato to try to keep the secret. And I will say, football or soccer in particular, it completely destroys everything. Like most sports, when you find out, it basically ruins it. But in this particular game, in my humble opinion, when you know the result, it's like I might as well not even watch it anymore. So,
no, I agree. I have the same thing with MMA. As soon as you see like there's a good fight, however, you can go and rewatch it because all the skill and everything involved. But I agree, if you're going to sit there for 90 to 120 minutes and you already know, because it's a low scoring game, that's the difference. And the second that edge gets put in, it's over.
Yeah.
Yeah, I mean, I'm probably going to piss a lot of people off with this comment, but I mean, let's be honest. Watching football is pretty fucking boring for the most part. It's mostly midfield, back and forth until there's a score or a goal. Not my cup of tea, honestly.
One thing I will say is that this World Cup in particular, there was a lot less diving. At least the matches that I saw, people going down and bloody clutching their ankles. That was a nice change because there's been some World Cups where it's just like, it's ruthless. You can't watch it. It's unwatchable.
What was that, like 2018, where the whole joke was like doing the Neymar, just like going down and holding the ankles? Yeah.
It was good actually. That particular season, that World Cup 2018, we just moved to London for 2 years, and you don't know anyone. There's nothing to do, but the World Cup was on, and that gave you like a reason to go to the pub, and it just was the great thing to break you into a brand new country because obviously it goes nuts over there.
Yeah, I think in some ways, like, this sporting event makes us Americans realize how insulated we are. Like, we're sitting around here saying, like, who cares about this? This is like so far and away the biggest sporting event that happens ever. Like, and the whole world rallies around it. Yeah. And then we're just like living in our own bubble.
What's interesting about this year too, even though I don't watch it much, this is the first World Cup I've noticed actually being on TV in the US. I haven't actually, it's so little watched here that 4 years ago, wouldn't have noticed it, and before that never even really paid attention to it, but it's actually on regular mainstream TV here this year, which is interesting. It's coming around.
The thing I find quite interesting about some American sports is most of your sports are very strategic plays, right? You've got timeouts in basketball, you've got NFL, which is like a slow strategic war game. Lots of American sports have timeouts, breaks, time to process and like plan the next move. Whereas for things like football, that we just whack on some extra time at the end of the match, and it's just kind of free flowing. That's definitely a big difference I've noticed.
And it is. I actually have thought about this a lot. So the sport that I understand the best technically is basketball. I actually, back in college, I called basketball on the radio where I went to school. Basketball is a great game. I have a huge affinity for it, but it has some massive design flaws that sports like football, aka soccer, and hockey don't have. And that's, the game slows down as it comes to a conclusion. It's a massive problem. Like, you get to the end of the game,
the last 30 seconds is as long as the rest of the game.
and the game completely locks up and slows down. Then you switch over to American football. 80% of the game, there's not even a play going. So it is one thing I appreciate about the flow and the style of both soccer, football, and hockey. And the two sports do have actually a lot of parallels.
Interesting. No, I've noticed that. We went to a basketball game. We're in Miami for the conference, and the last 30 seconds just goes forever. There's so many stoppages. It's so strategic, and they get the final shots in. It is very interesting like that.
Yeah. Hey, did we hear that you're on vacation kite surfing? Is that correct?
Yeah, that's my addiction. So when I'm not looking at on-chain analytics and Bitcoin, I'm trying to half kill myself in the wind and the waves.
How much time did that take you to get sufficient at to actually be able to get up and do it? Because it looks incredibly difficult. I've never tried it. It looks like a ton of fun once you get it. But
it's definitely a process. And the thing that I certainly enjoyed about it is how personal it is, because it's just you, your equipment, and the weather, right? So you're 75% in control, 25% up to the whim of whatever wants to happen. So for my first season, I just flew the kite, right? So just learnt the power, learnt how to, you pick yourself up on the beach and you can get some serious height with it. But the idea is that you get to the point where you don't have to look at the kite. You can just feel the power. So you know where it is, you know how much tension you need to put, and you know what the kite's doing. Once you include the kite and the board and then the waves, you've suddenly got something that's pulling you in one direction, the waves which are pushing you in another direction, and then your board, which is an anchor. As soon as it goes underwater, it's pulling you somewhere else. So the whole dynamic of it, the whole dynamic of it is quite challenging. So the first season was just flying. Second season was you do the walk of shame, which is where you can't go upwind. You can only go downwind. So basically you go out and you go like 600 meters down the beach, and then you've got to walk back with the kite, fighting it against the wind the whole way. You do one run and you're done. But there is a point in time, and for me, you just kind of hit that aha moment. And for me, it was putting the shoulders back. As soon as you put the shoulders back and you let the kite carry you, suddenly my board just starts edging upwind, and then it's just bang, away you go. So once you hit that point, which for me was 2 seasons in, it changes everything. But the learning curve is enough to throw most people off.
Yeah, I can imagine.
Giving up control to get control. That's true of
exactly
the technicalities of so many different sports, and it's completely counterintuitive.
Isn't it?
I can imagine you could
let yourself ease into it.
Yeah, I can imagine you can get yourself in some real trouble if you got a good gust of wind and you're just going out there.
I've had one. So you change your kite size depending on both your weight, but also how much the wind's blowing, or also different directions and things like that. But I've got a very light wind kite, and it's a huge mother. It's like driving a truck. 15 square meters. The thing's as wide as most rooms that you'll be in, probably wider. Anyway, I was out there on a beautiful light wind day, having a great run, and then the wind just went up like 7 or 8 knots in a very short span of time, and I'm out in the water. And man, I fought this thing back in, and I got to the beach, finally got the kite down. I just rolled over. I couldn't move for like half an hour. It was a true survival instinct move.
James, for people that don't know you, who are you? What do you do for a living?
Yeah, so I used to be, probably this time 2 years ago, I used to design tunnels, mines, basically anything engineering underground. So my background's in civil engineering. Worked in mostly in Sydney, but for most of the jobs that I actually ran were all over the world. So I've kind of done stuff with earthquake engineering. I've done stuff with tunnels, with mines, basements, all that kind of thing. So that's my prehistory. I discovered Bitcoin I discovered the space in 2018 and lost many small fortunes in 2018. Finally read the Bitcoin white paper in 2019 after the capitulation. I'd just seen everything go to 0 5 times. Then it just clicked. And there was something about markets that always fascinated me, particularly the way that human psychology plays into it. And I'll often describe the price chart as human fear and greed plotted against time, because it's all the pain, all the ups and the downs plotted against time. Anyway, so started to get into the, listening to all the podcast circuit and understanding what Bitcoin and economics and how it all functions and works. My actual orange pill moment, I'm going to give to Pete McCormick on his session. He did a series on Mt. Gox. And what was great about that is way back in 2013, you start hearing about all these guys that were going to fight tooth and nail for any tactic they could possibly muster to just get some kind of control over that business and those coins. And you start to realize the technical element of it, and why are people fighting over this thing when it's worthless back then, right? It's not worth anything. And people are willing to fight for it for their whole life. So you start to think, all right, there's something here. Anyway, so then I discovered on-chain analytics, which was really starting to be born in 2018. Things like the realized cap started coming out. And what that blended was my understanding, or my appreciation of markets and humans, my engineering background, which is data and models, and then also converting all of that into, take the engineering model, explaining it to a layman. And all of this kind of culminated as we came into February 21, which is where there was a job opening for Glassnode, and who's basically the leading, particularly for Bitcoin, on-chain analytics. And I just basically took a punt, right? I put in my my resume as a data scientist, because I taught myself Python. I'm not a data scientist. Put in my resume, but it was mostly about, I understand what on-chain analytics is. I've been teaching it for 2 years at a time when on-chain analytics is 2 years old. So I've kind of been there since the genesis of the field, and just learning along the way. And what I found is that people want to understand this thing. And the rest is pretty much history. It's been about helping people understand on-chain analytics, understand the edge it can give you. And particularly, it goes globally, right? There's people all around the world. I saw a video the other day from Vietnam where they teach the newsletter that we write each week in like a classroom full of people. And you see this thing, you're like, it's unreal. And these guys are training to be analysts so they can leave Vietnam and go work in the West and then send money back home. And you look at that and it's like, that right there, that's why I do it.
Yeah, there is a lot to be said about faking it till you make it, as you kind of imparted there. We feel like we've been doing that with this podcast since its inception, and maybe less faking, more making these days, but it's hard to say. I'm curious though, because of your Chainalysis background, just because of that idea, I wonder if technical analysis ever appealed to you. It's kind of along the same vein. It's maybe a lot more ancient, but has that been a topic that's interested you, and how much have you followed or traded that way?
Yeah, so I definitely learned a lot about TA, particularly 2018 and 19. I used to trade a lot more back then. I can do it, but what I found with actually trading is, and particularly with the work I'm doing at the moment, the trading, I find it takes your mind away from everything else. You have to be focused so much on the trade to do it well, and that's fine. But what it means is I don't have mental capacity to do all the other stuff that I have to do. So what I found is that I'm much better at actually having a clear mind, stacking sats, and essentially using my mind for the analytical side to help other people do that, whilst also having appreciation for it. Now, TA, in terms of its design, is kind of the same thing in principle. You're charting human psychology, fear, and greed against time, and you're looking for previous behaviors. There's a reason why the 1920s, you can look at a price chart and it looks like the same price chart we have now, right? You've seen these patterns play out over and over again because the markets change, the assets change, the dynamics change, but the human being and the human response is an old ancient monkey brain that keeps doing the exact same thing when given the same stimulus. And on-chain analytics is essentially that combined with the fundamentals of the blockchain. So the way to think about it is you go, okay, if I'm looking for people capitulating at the bottom, how is that going to show up on chain? And the most logical way is, well, people who literally bought their coins and withdrew them from an exchange at 50,000 are now selling them at the very bottom during a wick at 17,000.
Yes.
So you start looking for models and metrics that are helping you describe the human behavior as it would play out on the network. So it combines TA with blockchain fundamentals.
I think that does a good job of dispelling the haters, which occasionally we are. Like occasionally we fuck with TA on here and even on chain saying like it's astrology for men and all that stuff, which I'm sure you roll your eyes at. But the way you characterize it is totally accurate. And that's when you analyze human behavior, there's an innate recognition that there's no way the conclusions you're going to draw are going to be ironclad or perfect or get it every time. So when you go back to first principles and say on-chain analysis and technical analysis are a high-level zoom out on human behavior, it helps people I think cut more slack where it's due when things are incorrect or quote unquote wrong, right? It would be the same as judging someone for incorrectly judging human behavior instead of it being some hard science like physics, you know?
And you know, when you look at things, it's actually on-chain. People say that you can spoof order books and, you know, you see these scam wicks that happen and all that kind of stuff in TA. In order for a whale to, you know, fake a whole bunch of capitulation losses, they literally need to have moved coins up at 50,000 and then not moved them again until 17,000. You can't lie. And if you are going to lie, you still have to pay the blockchain fee, right? So it's one of those.
Price.
Exactly. Now, the trade-off is that, and a lot of people also come at me with this, it's like, yeah, but all the trading volume goes on off-chain, right? They say all the trading volumes in futures and spot, and that's not on-chain. It's like, yeah, that's fine. However, when you look at, a lot of people just look at like the exchange net flow. Oh, look, on net, 10,000 coins flowed in or out. But what they're missing is that, no, 60,000 coins flowed in and 55,000 flowed out. Your net may be 5, but there's literally billions of dollars in BTC flowing in and out every single day. And when you look at it, sometimes it's between 30 to 70% of spot volume flowing in and out. And on top of that, we're actually seeing that after all the FTX shit show, more people are taking their funds off. And if you think about it, right, there's big trading desks that just got wiped out on FTX. And you're going to tell me that they're not going to be pulling their profits off exchanges coming the next run? Absolutely not. Like, they are going to be using that on-chain wallet as their self-custody. It'll go through ebbs and waves, but 87, 88% of all coins are off exchange. So, you know, if there's no signal there, I'll eat my hat.
I want to ask a zoomed out question, and then we'll dive back into on-chain because I know it's going to be the reason for the answer. Fill people in on where you think we're at right now, generically. I know you've been on record recently as saying you think I think you've even said historically oversold. Start out by the what, and then bring us to the how you've reached that conclusion on where Bitcoin sits today.
For sure. Yeah. So again, look, no one knows the future, and you know, you got to caveat all this shit painfully. With, you know, look at the world around you, anything can happen. So there is nothing set in stone. Nevertheless, what I generally look at, we're talking about all the psychology of things, right? So what I'm looking for to try and form some kind of bottom thesis, right? Realistically, what do we actually have? The only thing we have is the historical data, right? And then you must contextualize it. So, you know, let's just put for a moment to the side, put aside the macro scope. And so, you know, people are saying, oh, Bitcoin's only existed in an easy monetary policy, blah, blah. Okay, cool. That's fine. Let's put that to the side because that's literally all we have. So now let's just look at what we have and then we'll assess it in the context. What we have is when you're looking for human psychology, what was the pain threshold that was required in every previous cycle to flush out every remaining seller? And every remaining seller are the forced sellers, right? In this season, we've seen all the forced liquidations and the lenders and blah, blah, blah. We see the miners who become forced sellers because they just, for some reason, seem not to sell anymore. Definitely there. Yeah, I say miners, we're definitely there. You look at the short-term speculators, go on Google Trends and tell me that we've got any short-term retail coming back in, gone. And then the last one that's left is the long-term holders, right? The hodlers. So even the most steadfast, devout hodler will panic at some point in time. Now, once you've survived 2 or 3 seasons, 2 or 3 cycles, you're good, right? You understand why you're here. Your cost basis is low enough. You don't really care. So when you start seeing them flushing out, and we've just seen the second largest flush out of long-term holders, people have held their coins for more than 5 months. People go, that's not a long time. It's like, well, statistically speaking, they are the least likely to spend. So you kind of map back and you look at what are the preconditions that has caused human psychology to reach the pain threshold where it's like, get me the fuck out. And we have all of them across the board lit up saying, you know, for the most part, the amount of pain in the market right now has put a bottom in every previous cycle. And the last thing I'll talk about is the kind of the resetting of the cost basis. So for example, you guys have been in this market for a while. I don't remember the price of the coin I bought in 2018. It's just somewhere, and I don't care. It's just part of the mix. The coin I bought yesterday, I know exactly the price that I bought it because it's recent history.
Mm-hmm.
So what happens is that recency bias gets baked into how people consider the market. So what we've seen very recently we look at different, we call it the realized price, the average price at which every coin moved. And you can break that down into cohorts, right? We can see the average price at which every coin moved, including Satoshi, which is 0. You can see of those long-term holders or the hodlers, and you can also see of the short-term holders, people who recently bought. And where we are right now, there's a couple of things that are in play. All of those cost bases have essentially clustered between like 20 and 22,000. So what does that mean? They diverge during bulls. New buyers are buying the top. Old hands have got coins from 6,000. The market's all over the place, right? These things open up and widen out. As you get to the bottom of a bear, everyone who is going to sell has sold, which revalues the coins lower. Everyone who's stepping in to buy the bottom buys those coins. And what you end up with all the cost bases in the same place, and the people who just bought have outperformed guys who've been here for the long term. So that to me means that the long-term guys are underperforming the guy who just bought. They're in a whole shitload of pain. And because all the cost bases are in the same price region, the market is now homogenous. There's no difference because, I mean, who cares if your cost base is 20,000 or 22,000? It's somewhere around 20,000. So as a result, the market has returned to a homogenous base. And when you get to a homogenous base, everyone's the same. Everyone has the same cost basis. If we dunk lower, maybe that means the whole market's going to puke and we do this bear market all over again. But at the same time, every previous time this has happened, for every seller, there's a buyer. And every seller who's revaluing their coins from 50,000 down to 17, some other guy has now got a $17,000 cost basis and he's pretty happy about it.
Yeah. So one of the things you identified there was that these holders of last resort, the guys who will not sell, or the people that are in serious pain right now, those are kind of one and the same unless they've been holding for, say, 5 years or so at this point. Paul Tudor Jones actually cited that as one of the reasons he became interested in Bitcoin, because he said, 100%. I think it was something like, I can't remember the number
like 80%
exactly.
or something.
83% is what's coming to mind for me. And I think he said 83% of people would not sell. Didn't matter if it went to $3,000, 2,800 or whatever the low was in 2018, 2019. They just simply didn't sell. And I'm kind of reading from what you're saying here that that's very likely to be, we're in that region right now. We're in that 80% of these people are just not selling, they're holding, and they're resolved to do that.
And even anecdotally, right? I've had people who, they were asking me whether they should be buying at 60,000, and some of our YouTube comments, right? We put out a video on Glassnode every week, and YouTube comments are generally very, very good, right? Thanks for the information, blah blah blah. We're starting to get ones coming in going, this fucking market just goes down. That's it. I love the content, but I hate this asset. It's all going to zero. Like the capitulation comment. You're like, You just sold at 30 cents, didn't you?
It is totally true that to no coiners and outsiders, like hardcore Bitcoiner behavior is psychopathic. Like that's an extreme word, but I think somebody.
It's appropriate.
I'm sure everyone that works in this space gets this question. I got this question yesterday from somebody who said, "Are you still doing that podcast thing?" And I didn't like tee off, and I'm like, "Yep, still doing it." And in the back of my head, I'm like, "Not only are we still doing it, we've had our biggest months recently in the middle of this bear market. Like we're scaling month over month because people are more hungry for information when the price is cut off 70%. Back to the Tudor Jones comment, it is very atypical from other markets. It doesn't mean we're right. We could all be the biggest clowns in the world theoretically, but interest grows for people that are hungry learners, even when all the euphoria is rinsed from the rest of the market. And it is super atypical from anything else I've paid attention to.
Yeah, and when we see volatility, people are like, for Glassnode, you guys having a hard time in as the bear market rolls over. It's like, no, volatility is good because people want to understand why, right? Some of our biggest sign-up days are when you get these enormous down wicks and people explain what the hell happened. And that's essentially what we try to do, right? You try to build the tools to be like, right, let's actually explore what were the dynamics that led into it and what are we looking for as we move forward.
I've got a question just on this on-chain movement idea. So Willy Woo is somebody who was very popular in 2021. Dan and I paid a lot of attention to what he had to say, and he got a lot of things really wrong. What do you think? I don't know how much you paid attention to what he was saying or what the kind of distributions he was making, but can you identify where he maybe had it wrong or what he did wrong there? Just from your anecdotal knowledge of it?
No, totally. And look, I can't really speak to it because, to be honest, I don't pay that much attention to many other analysts because similar to the trading, I actually like to just have my own running thesis. So I actually, to be honest, don't know a great deal of what his calls were. But what I will say, at least from my experience, so I joined Glassnode February 2021, which if you can envision yourself, that's post Elon candle, and we're in the topping formation, right? 50,
Yes.
60K.
That's good context. Yeah.
Exactly. Now, when I go back and look at myself as an analyst, right, I've suddenly been dropped in. I was employee number 8 at Glassnode back then, right? So small firm, first real analyst who understands what the on-chain side and is now writing reports to help people understand it. Now, at this time, if you think about the world of Bitcoin, the market's matured to the point where we have enormous derivatives. We have leverage. We've got options markets. You've got Michael Saylor doing his thing. You've got questionable institutional interest, right, in and out. You've got GBTC. You've got an enormous scope of stuff that changed within the last 3 months.
Mm-hmm.
So I get dropped into Glassnode, and suddenly I've got all these tools. Now, there's no chance that anyone's going to learn the full scope, right, to the extent to be able to explain what each of our metrics does in a couple of months. So when I go back and look at myself, I got a lot of stuff wrong. One thing I got very, very wrong was that first May decline, right? The sell-off in May that I think started this bear market, 2021. So that was my...
that was a brutal downturn.
Wait, let's go on a tangent here, because I heard you say, Checkmate, that you viewed that as sort of a, I forget how you put it, like a fake out or a it wasn't a true next pump after that original downturn. Go back and explore why you think the bear market really started earlier, and then that scammer pump, so to speak, or however you characterize it.
No, totally. And look, lots of people are looking at the FTX thing, and I saw a couple of comments. People are trying to attribute FTX to why we had the rounded top. Now, the rounded top, in my view, is almost entirely due to the GBTC going into a discount, because that was, I mean, they absorbed 660,000 BTC in a handful of months, right? So that enormous spot buying pressure, suddenly that went wrong. And then also we now know there's lending books and blah, blah, blah. So anyway, that rounded top, the peak in on-chain activity. Now, when we talk about what does the peak stand for, I might just describe the whole 2021 phase, because I think it's linearly. So the peak in on-chain behavior is essentially when long-term holders are cashing out the hardest. The most amount of supply is coming from dormant cold storage back into the market. Active addresses, transaction counts, the on-chain activity, block space demand, fees, generally peaked in January, and everything started dying off. So prices making less and less, but higher highs, right? Slightly declining, but higher highs. And everything about fundamentals was in a massive divergence to the downside. So what does that mean? That means that you have less usage, more supply, and waning demand at a time when price is making higher highs. Then you overlay GBTC, and you're like, right, not good, right? So you look at all those things in context, that looks like a top. Now, the sell-off that we had in May, this is essentially where I think there's been 2 points when my analysis or where I'd class myself as an analyst changed. When I came in February, I understood on-chain analytics. I didn't understand the full scope of what we could do with this stuff, plus derivatives, blah, blah, blah. So missed that first sell-off, but that's when I'm spending every day in this thing. As we formed that bottom, May, June, July, that's where I started understanding more about our supply metrics. And there was, the whole supply squeeze narrative. A lot of that actually backtracks to a tweet and a report that we put out way before. So we were talking about how we're seeing this like changing behavior. The supply is starting to actually go back into dormancy. We're seeing the hodlers have actually stopped selling, and you're starting to move into this regime where there's actually buy side going on, right? Now, then we started to rally up towards the November all-time high. Now, the September dip quite clearly looked like a dip. But as we push to November, what we did not have, and I will never, ever make this mistake again, I was screaming that there is no on-chain activity supporting the rally. So price is ripping to all-time highs. But there's two things, the one that I was banging on about, and then everyone was saying, no, don't worry about it. It's all happening in trading off-chain, right? So I'm looking at this thing. Price is at 69,000. And the amount of transactions, active addresses, network usage, block space demand, like half what it was back in at the April peak.
Wow.
And massive bearish divergence. I'm looking at this thing being like, It just doesn't feel right. But everyone's like, but it's all happening off chain. I was like, fuck. What if on-chain analytics is actually losing its signal here because it's all happening off chain? Big mistake. Big mistake. What I wasn't focusing on is I got caught up in the hype myself, right? And you realize, hang on a second, no. The on-chain analytics was dead right. Our interpretation was wrong. And I should have trusted my gut. And the second piece, in hindsight, as I've kind of studied that more, massive bearish divergence, both during the first top and then a macro one between the two peaks. That also exists for what we call profitability metrics, right? So if you bought your coins at 10,000, prices at 20,000, you've got 100%, you've got a 2x. That's what the MVRV tracks. Now, the MVRV also had a lower peak. And what that means is that there is less profit in the system than there was back in the April high. How do you
just
have
tell
less
us what is MVRV real quick before you keep moving on, just so that we're all on.
MVRV stands for market value, market cap or price, divided by realized value. Market value to realized value ratio. Realized value is realized cap, realized price. So what you're looking at there is what's the current price and taking a ratio with when did everyone buy their coins on average, right? So it's like a profit multiplier. Now, if you've got less profit, unrealized profit in the system, even though your price is higher, how the hell does that happen? It's because people who had their $6,000 coins just sold them at 60,000. So there's literally less profit because more coins have been distributed to a higher price. So on-chain activity, massive bearish divergence. Profitability, massive bearish divergence. All of these things were saying, guys got out. Guys got out in a really, really big way. In April, they bought down there at May, June, July, and then they sold like crazy as we came up to that second peak. So overall, those were my two big lessons. First lesson, obviously just getting thrown in amongst the data back in May, start looking at this data more critically. On the second all-time high, it was, okay, on-chain has not lost signal. People are just interpreting it wrong. And from that point on, basically studying this bear market, which is kind of ironic because I got in 2018. I was forged in that first bear. This second bear is where I got forged as an analyst, studying how this thing really works, getting real critical about it, and cannot wait for the next bull because that's good. Trying to find the blow-off in the next round is going to be the fun game.
Folks, SWAN Bitcoin is the place we point friends, family, and fellow firefighters to buy Bitcoin. SWAN is a secure, education-focused, Bitcoin-only on-ramp fit for novices all the way up to full-time financial professionals. SWAN's exceedingly easy-to-use interface enables you to dollar-cost average daily, weekly, or monthly, as well as conduct instant smash buys. Withdrawals to cold storage are completely free and can be totally automated. SWAN wants you to hold your own private keys, and support is one click or phone call away if you need help in that process. Additionally, check out SWAN Premium. This gives members exclusive Bitcoin educational content, discounts on Bitcoin products and services, and privileged access to SWAN events. Normally $20 a month, you can get SWAN Premium for free for the first year at swan.com/premium, and it's free for firefighters at swan.com/fire. All SWAN services can be found at swan.com.
Blue Collar Bitcoin is brought to you by Crowd Health. With open enrollment upon us, what if you didn't have to pay healthcare premiums anymore? What if you could invest in Bitcoin instead? With Crowd Health, you can put aside money for health expenses in your own account and even hold a large part of it in Bitcoin. If Bitcoin goes up, you get the upside, not big insurance companies. Pay one low monthly total to fund an account that is yours. Choose your doctors and hold up to 75% of the funds in Bitcoin. If a large expense comes up, Crowd Health will crowdfund the bill and pay it quickly. Stop supporting the broken health insurance system with your hard-earned capital. Go to joincrowdhealth.com and use code BLUE now and experience freedom from health insurance by utilizing Bitcoin. Right now, through the end of the year, you can get your first 6 months for just $99 per month. Don't get stuck in a bad insurance plan again. Instead, go to joincrowdhealth.com and use code BLUE to sign up. That's joincrowdhealth.com, promo code BLUE. Crowd Health is not health insurance. It's a totally different way of paying for healthcare. Terms and conditions may apply.
The Blue Collar Bitcoin podcast is powered by arguably the most legendary company in Bitcoin, Kite. Use promo code BCB for 5% off select purchases, including the cold card, at coinkite.com. Established block 141,000, Kite is an industry leader in security and hardware manufacturing. They are producers of the renowned Cold Card, the world's most trusted and secure Bitcoin signing device or hardware wallet. It's built with a plethora of features fit for Bitcoin beginners all the way up to the most advanced of users. This device is a one-stop shop for your Bitcoin custody needs. CoinKite also manufactures the Block Clock, a gorgeous e-ink digital art display piece sitting in the background of every serious Bitcoiner on planet Earth. Block Clock can be programmed to scroll through key Bitcoin metrics including price, hash rate, the next halving date, and much more. CoinKite are also the makers of the Open Dime, a small USB stick that allows you to spend Bitcoin like a dollar bill, passing it along multiple times. Check out CoinKite's entire suite of products at coinkite.com.
And here's the thing with that is, back to the previous point, it's as unpredictable as human behavior. Like when these markets end, it's easy to Monday morning quarterback. Hindsight's always 2020. And when I look back at, like, say, the calls by Willie Woo, who was calling for hundreds of thousands of dollars, and I was eating it up like a smorgasbord too. I mean, I was, especially when you,
dude, he was saying back up the truck at like 55 grand, like it's go time.
Hardcore plebs are like prepared, but also vulnerable for these environments. Because when you study the magnificence of this protocol and how significant this discovery is, when it starts to skyrocket, there's a whole host of hundreds of hours of research and conviction built on real substance that are causing you to filter this new hyped speculative information through how you perceive the magnificence of this asset. And the truth is, in these environments, they are, when it gets frothy like this, they're incredibly speculative on a brand new asset. Most new entrants, right? We're onboarding orders of magnitude, not just percentages of, but orders of magnitude new users. They have no idea what they hold. Mind you, this thing has a totally fixed inelastic supply. Point I'm making is that where this concludes in these hype cycles, anybody knows. It ended at 69,000 this last time. In that same environment with different inputs, it could have been 169. It could have been 269. And the next time this happens, we're not going to have any clue either. All I can say is you have to strike some balance between a sense of urgency to get a seat at the table and not completely losing your mind amidst the hype. But that is a tough, tight wire to walk. And that's part of the reason why it's easy to pick on it right now. But dollar cost averaging makes a lot of sense if you have strong conviction in the potential of this and you just don't want any part in trying to time markets that are virtually untimable.
And even further to that, you mentioned before, where did analysts like Willie go wrong? And in my view, it's actually fairly simple. They gave price predictions. And you'll notice that I don't give price predictions because I don't know. And I can't tell you what the price is going to be. I can tell you what it should be. And the answer is much higher than where it currently is. Nevertheless, what I think is far more useful for people, but it's not as meme worthy. This is the thing. It's not as memeable when you try to explain why things are happening. Because when you explain why things are happening, which is what on-chain analytics is fantastic for, you understand the climate and the weather, right? If it's cloudy and you had rain yesterday, is there a high probability of rain today? Yeah, probably, right? But it doesn't have to rain, but it's much more likely than if it's blazing sunshine.
For sure.
Right? So what you're trying to do is understand what is the macro flow of this thing. And when you understand the macro flow, particularly for DCAs, you can find periods of time when the old hands are getting out. And this is my favorite thing. In the bull market, everyone is looking at, we've started the bear and people are looking at all the previous data. And you'll see metrics that I know are old hands selling, right? Lifespan, coins coming out of dormancy, coming out of cold storage, flows into exchanges. The average punter looks at the metrics that we have and goes, but look, that one goes up during a bull. I'm like, yeah, that's you getting dumped on, sir. Like, people look at things going up in the bull, but they don't realize that's the exit signal. You have to be the contrarian. You have to be, where is the smart money? And the great thing about on-chain analytics is we can see the smart money. They're measured by one thing. How long have you held your coin? Right?
Yeah.
If you have held your coin a long time in cold storage, I want to follow that guy.
I think one of the things that threw us off, I think myself for sure, Dan, probably you as well, we watched this 2017 bull run and it looked, the setup, the way that it moved, very different from 2021. You had this massive blow off that went from like 10,000 on like December 10th of that year to like 20,000 7 or 8 days later.
It was crazy.
Exactly.
I remember sitting on coins at that time going, holy shit.
We had that though. People just don't realize it. It was January. January 2021 was that. We were at 10,000 Next minute, we're at like 40,000 within like a month. Like December to January, that was the blow off peak. I mean, you have to remember, we came from COVID, 3,800, whatever it was.
Yeah.
That was the peak.
Yeah. I guess what I'm trying to get at, though, is that like the way that this thing is going to present itself is very unlikely to look how it did the last time. So 2017 had a very, very, fast moving top that, peaked out and then shit the bed very quickly. And then 2021, depending on exactly. And then depending on how you look at it, I mean, I can totally subscribe to what you're saying that the true peak was in the early January, February of 2021. But then this thing, goes down, goes up to 60, goes down to 30, goes up to 69. And I'm thinking, holy shit, we're strapping in, we're ready to go. And boom, it all blows up. So this double top almost. So there's no way to know how things are going to play out in the future. It might be more like 2017, might be more like 2021, this slow burn. But trying to predict these things is a fool's game, in our estimation. And yeah. I think that your on-chain metrics are certainly helpful, but I think the DCA is the way that I'm viewing this thing from here on out, because I've made enough large purchases at higher prices where I'm just not playing that game much more.
So that's where on-chain analytics really helps is, and again, like everything, you need to do a little bit of proof of work. What me and my team are trying to do is make that proof of work as quick as possible, right? Give you the guidance and all the rest of it. But to avoid those large purchases at high prices and to instead allocate those to lower prices and conversely, allocate those sells to a higher level, that's where these tools come into effect. Because essentially, the way I DCA, right? I primarily DCA for the same reason I don't trade. Keeps my mind clear, keeps my sat balance going up. But I will use the tools I have. If it looks pretty sketchy out there, I'll just hold my DCA until it's looking a little bit brighter, right? And generally speaking, you get a 20, 30, 40% discount. And it just if you do that DCA with that extra edge tapped in, suddenly you can start adding 10, 20, 30% to every single purchase. And you start exactly your dollar cost averaging your smarts as well as just your BTC.
Yeah, that's a really, really good way to look at it.
We also appreciate the discipline in your analysis, because you're right, making price predictions, it's like taking a risky shot at glory. And if you happen to be one of the last men standing, it gets a lot of attention, but it's probably not rooted in the best principles. And it probably also doesn't, like if your aim is to be altruistic and give your talents to those who are trying to accumulate as much Bitcoin as they can, calling massively high numbers probably isn't additive to people's process
it's
on the
horrible.
way up or down, No,
totally. And like, that's the thing. What I really hope that Bitcoiners by and large do is never allow stock to flow to ever happen again.
Yeah.
Like, we had some very, very bright analysts, including myself, screaming about how much of a scam that model was for a long time. But we had all the big podcasts had Plan B on to talk about it. And it hurt a lot of people. I don't think people realize, and psychologically, the reason why May, I think, was the bear market start, two things. On-chain activity cratered. And same as the 2017 top, actually, almost identical. All of the bull market activity just evaporated in one candle, just gone. And think about how many Bitcoiners were expecting 150, 200K, and they got 29. Yeah. And that just, and most of them, we don't realize, because we've been here for a long time, most people bought 50,000 plus. They weren't buying at 10. They had no buffer. So Plan B harmed this market in a way that I still feel like I'm cleaning up that mess. I still get people coming to me and saying, I just don't understand like what happened. And you explain to them, they go, right, makes sense. But we as Bitcoiners need to make sure that never happens again.
Yeah, it was insane. You're right.
To pivot here, and I can already tell at the 40-minute mark, we're going to go long because we're about to pivot into a giant rabbit hole. I'm going to start it this way. We're going to talk about the uniqueness of Bitcoin, maybe how it compares to Ethereum. Before we get into the nuts and bolts of that, walk us through your journey. I pay a lot of attention to you on Twitter, and I've paid some attention to what I perceive to be a little bit of a change in tone, but I love your tone when you embark on this discussion. You put out a video on some of your concerns about the Ethereum merge a few months ago. Not only what was in it was I impressed, but it's the way that you communicate it, the humility and just the process you go about. So walk us through how that's been for you. Where did you start in this space? Kind of where are you now? Take that wherever you want.
Sure. So yeah, I mean, as most people do, when you come into this market, everything looks the same, right? Bitcoin is, Ethereum is, whatever, right? It's all a price. So my very, very first, not only just buy in this space, but my first investment ever, no stocks, very, very first asset that I ever bought was Ethereum at the January 2018 peak on Coinbase. And it's even worse than that, because when I was doing my taxes, the buy that I had, Coinbase had an extra fee for Australian dollars. So my buy price is actually above the top wick. So talk about top buy. You actually can't get more top than that. So anyway, that was my first buy. And through 2018, it was just shitcoinville, right? Spreadsheet, 50,000 coins. They've all got $10 allocated to them. They all go down to 1 cent. But Ethereum was one of these things that, like, I could see what was going on, and it was interesting, right? I discovered the economics and the monetary side in 2018, 2019, late 2018, 19. And that's when I pretty much went down the path of being like, all right, Bitcoin is, this is what it's all about. Now, from that point, that was kind of my peak maximalist phase. Then I went through a phase of actually exploring other projects and just understanding things like governance, security, things like that. And I started to get an appreciation for, okay, I don't think that it's just Bitcoin, but also the trade-offs matter a lot. And anyway, Ethereum is one of these very interesting assets where I have flip-flopped for years, right? Trying to understand, this doesn't make sense. And I wrote papers about this back in 2019. I'm like, I can see how the changing of the monetary policy doesn't make sense. There was lots of elements. The governance layer was a bit captured. There was also just the sheer fact that the thing is not going to be able to scale because of blockchain mechanics and the trilemma and things like that. So I was constantly just back and forth being like, but there's these smart guys who just seem to get it. And I keep trying to work out what the final solution is. Anyway, then you start getting, then the whole DeFi summer thing blows up, right? That was June or July, whatever it was, 2020. And there's no question, right? When you look at that stuff, things like Compound is a fascinating protocol because you can just put money in one side and borrow from another, and the whole thing's collateralized. You get automatically liquidated. And as credit to showing that these things actually work, you saw all the Celsius and all these bodgy guys, they had to go and close out their DeFi loans first. Why? Because it's indiscriminate. I don't care who you are. It's going to liquidate you if your price goes below that level. Now, that's not perfect because there's two elements that make DeFi work that I think we just have to all accept are not, cannot, and probably won't ever be decentralized. And that's okay, right? You can have a system that's not as decentralized. The problem is you have to apply the right tool for the right job. And that tool is not money, right? You cannot be centralized and be base level money. So the two things that have always, well, let's say three things that have always struck me as long-term problems for this industry. And by this industry, crypto and Bitcoin, right? The crypto industry. There is the price oracle problem. Blockchains do not know the price of anything. Now, you could argue that they could do with Uniswap, right? Because you've got a pool. The problem is you now have a single attack vector that someone can go in with enough liquidity and blow out the peg. So the oracle problem remains very, very problematic. And the reason why is that you need a centralized server who takes prices from Coinbase and Binance and BitMEX and averages them out. And then you've got a nice stable index. It's very, very hard to manipulate. Now, that's fine to manage on a central server. If you start pulling things like if you can only point to on-chain sources, essentially Uniswap becomes your attack. And it's all about finding what is the weakest link. Now, if the oracle gets captured, someone can just change the price and liquidate everyone, right? And if you think about it, the bounty, if every single system is using the same oracle, the bounty is all of DeFi. Every single coin that's locked in DeFi, that's your target.
Yeah,
so
that is a
the more
great point. Yes.
The more useful it gets, the larger.
I want to make
the
sure that
bounty.
we are on the same page and everyone understands what you're talking about here. So the oracle is what tells the protocol what's reality, right? It tells it what the price is of reality. I just want to get back to this. So the attack vector would be, so you could somehow manipulate the oracle to change the price, manipulate it, and then position yourself in these markets to either to be on the correct side of that trade in order to just crush.
So let's say Bitcoin's at 50,000.
Code is law. In the land of DeFi, code is law.
Right.
You know what I mean?
Yes.
There's nobody
You deposit one BTC, it's worth 50 grand. You borrow 30 grand, right? So if Bitcoin falls down, I don't know, just 30%, you're going to get liquidated. So what happens is the guy can just get in there, and if they manage to change the price of the Oracle, whether via, let's say there's $1 billion worth of coins that they could buy at that liquidation price, if it only costs them 900 million to push the Oracle price down, and they get 100 million as profit, it's a worthy trade, right?
Right. Yep.
So that's a problem that to date, it's like the Oracle problem. Feeding external data into a computer system is an unsolved computer science problem. So that's the first one. Second one is the absolute reliance on centralized stablecoins. The entire system only works. We saw this with Luna. These algorithmic stablecoins are not going to be stable because every price currency peg in human history ever has always been broken. There will be a George Soros out there who will break it. So thus, the only way this system works is with centralized stablecoins. Now, that's fine. The problem is that you have to accept that that is your weakest link. We're trying to find what is the weakest link in the system. And if you must have centralized stablecoins, you then look at, and I raised this in the video, they recently had the merge. Well, what happens if there's a fork down the road somewhere, a fork choice that is, well, we have, and we're seeing errors of this. You have to be, you've got to share your IP address, or you must be KYC, or any of these, what sounds extreme. But do we think the government's not going to fight this stuff? They absolutely are. You want to move dollars around the system? They're going to bless the stablecoin. They will bless USDC and say, this is our, approved stablecoin. But if you want to use it, we need to know who you are. And institutions and banks who are required for this whole thing to work also need to know who their counterparties are for legal reasons.
Right. And that's going to be the Achilles heel of this entire thing.
Because, exactly. And this is the debate around the fork choice, which is that let's imagine that we get to that fork in the road, which is which side are you going to choose? Are you going to be on the rebel Ethereum side, or are you going to be on the compliant Ethereum side? Now, if you choose the compliant Ethereum side, all of your DeFi protocols will continue to work. Your stablecoins will continue to work. Everything will press on as it currently stands. You just need to KYC, to which, you guys surely know that most people, when you talk about privacy, they're like, but I'm not doing anything wrong. That mindset. And if you add that mindset with, by the way, you're also not going to lose everything you own and your protocol will keep working as designed, 99% of people are going to go, yeah, sounds good. The other side is you can keep your rebel Ethereum, but you're going to have to slash Coinbase. You're going to have to slash Binance. You have to slash Lido. All of your stable coins are going to go to zero because Circle will not honor a coin that's on a non-compliant chain. So you're going to have to sacrifice pretty much everything that makes your blockchain functional and work. And a lot of people say, but that's the risk that, we're willing to take it. It's like, that's fine. But how well do you think that's going to go down with everyone else? Do you think retail's ever going to come back to you when you slash their Coinbase balance?
No.
It's just not a real scenario. We can envision it all we want, but it's just a really uncomfortable spot to be in. So as a result, because DeFi only works with centralized stablecoins, essentially they have now got fork choice over the protocol, because if they say we're not valuing USDC on this fork, good luck keeping that fork alive.
Oh man, this point is such an important point. And the stable coin influence over the outcome of these hard forks is one of the first things that really clicked for me. And I think it came from Lyn Alden's An Economic Analysis of Ethereum piece, where she really deep dived on how much the whole quote unquote DeFi ecosystem is completely reliant on these things. And you've done a great job of reminding us, like, who's the end user? Like, I think if I remember right on your video, you used like little Timmy as your example throughout. Like, guess whose balance is on Binance or Coinbase?
Yeah.
It's the average Joe. It's the average Huckleberry that doesn't really fully understand this space. It's a mess of wayward incentives. Before we keep going,
we actually just saw that, right? So if FTX just wiped out a bunch of little Timmys, you're telling me that the Ethereum community is going to wipe out little Timmys on Coinbase and expect people to ever buy your token again? It's just a very, very bold claim. Personally, I kind of want to see the movie because I think they might try and do it, but I don't think it's going to end well.
Yeah. The other Lyn piece that I actually have out in front of me highlighted into an oblivion is her piece that she just released titled "The Problems with DeFi and Crypto." For someone listening, resources to if any of what we just explored, which is super significant, went over your head, We're going to link Checkmate's video on the Ethereum merge, which explores a lot of this stuff in the show notes. And then I'm also going to link the 2 articles I just mentioned by Lyn that are well worth your read. The other thing that I think is worth you enumerating for us is the difficulty of even running an Ethereum node. Can you peel back that onion slightly, Checkmate?
Yeah. So, and that's actually the third pillar. So I mentioned there was the 3. There's the Oracle problem, the stablecoin problem, and then there's the look. I think Bitcoiners give Ethereum a little bit too much grief about node size. That said, it's not a problem, right? It is a problem, but it's not as it's much more nuanced than what most Bitcoiners just say. Oh, it's Vitalik's masternode. It's not. So some anecdotal information here. I've tried to run. In fact, I put a tweet out the other day. Pretty much, I'm at the point now where when I reboot a laptop, one of the first pieces of software that goes on is a Bitcoin node. Now, Bitcoin nodes, whether on your own personal hardware with a Raspberry Pi or your laptop, is trivial to get set up. Trivial. And very rarely do I come into any kind of problem. I have tried running an Ethereum node about 3 times. The only one I've ever managed to get working was using a quick sync function, which is essentially goes to a checkpoint, downloads, and then it's like a fast sync. Now, that's not really what you should be doing. You should really be downloading and validating the whole chain. So
right.
The hard reality is that if you run more stuff on your blockchain network, as Ethereum does, Bitcoin, all it does is move UTXOs around, right? That's it. It's basically a big database. What the Ethereum is doing is obviously orders of magnitude more complex. So the trade-off is that your data footprint is much larger, the amount of work your computer needs to do. You can't use a hard drive. You need to use an SSD. It will consume a large portion of your computer. And further to that, there's a lot of maintenance required. So when they do a hard fork, you need to have upgraded your software before that. And, people can poke around. The trade-off with a hard fork is that you kind of need coordination. So there's a bit of a centralizing force there. But simultaneously, if you have to keep hard forking your software, you're adding technical requirement to your end users. Now, I mentioned in the video as well, Little Timmy doesn't run a node. I've been using Ethereum for, 5 years, thereabouts. I have never, ever, ever connected my MetaMask to anything other than I've tried to connect it to my own node, but that node was so heavy on my laptop that I just couldn't do anything else. So, sorry, the node's got to go. MetaMask just you can run your ledger all you want, but MetaMask is connecting to someone else's node. We see this across a lot of elements of it. Most Ethereum nodes run through some kind of data provider like AWS or Infura, blah blah blah. So there is a force that pushes these nodes onto the cloud. The data footprint is heavier. In terms of maintenance, basically, I see lots of people talk about this, particularly data providers. Ethereum's node requires a lot more work. You need to be a bit more hands-on, need to be more technical. You need to be upgrading all the time. Bitcoin nodes just keep chugging along, right? They just keep chugging along. Even at Glassnode, maintaining the Ethereum node is a process. We have multiple Ethereum nodes with different clients, and keeping them all operational all the time. You have to literally be tracking Twitter to see when a hard fork's coming up, which is a bit of a challenge. Bitcoin, you just set and forget. The thing just ticks over, and that's a common story. So that node, call it centralization force, is a trade-off, but it's also it shows you that there's actually elements there. There's a few more layers like MEV and stuff, but I'll pause there.
Yeah. So just a couple of things on top of ETH before we move on from it. 2 things I think that are important for people to keep in mind and think about, especially if they're involved or want to be involved in ETH in any way. The staking of ETH, number one, is fairly complex as far as I understand. And because of that, people have basically used centralized parties, which are Coinbase, Lido, a few others. They're basically centralized entities that can make the choices for you as far as your staked ETH. So the first question I have on that is because of these centralized third parties that are doing the staking for people, do you think it's accurate to say that ETH is effectively captured at this point? Whereas
yeah, it's a really interesting question. The answer is we don't know. The same way that we don't know that Bitcoin is secure, it's because it's all probabilistic. Show me in the data. Based on empirical data, it is, right?
Right, so but I would say, I mean, if you were going to say, probabilistically, do you think it's a fair statement to say that it's much more likely completely centrally controlled at this point than it is that Bitcoin is not secure?
Yeah, I would say that if you look at the trajectory pre and post proof of stake, there's no question that it is heading towards centralization. Now, what you have to look at here is it comes down to block construction, block production. So little Timmy is going to seek out the most convenient option because that's just what human beings do. This is not a blockchain thing. This is just a human thing.
Yes.
People want to delegate risk. 32 ETH, even now, is $32,000.
It's a lot of money.
The vast majority of people, that's a huge amount of money. Now you're going to ask that guy to maintain an Ethereum node. By the way, it's not just one node now. There's two nodes. You have to do execution and client. So there's two execution and consensus. So you actually need to run two sets of nodes. You need to keep those up to date through all the hard forks. And you need to put $32,000 on your laptop, have it live, and be quite confident that you're not going to fuck up security and someone's going to steal it. Now, most people use the word password 1234 as their password. So you just have to be realistic and say, we expect that the vast majority of people will delegate that risk to Coinbase and Binance. Now, that, and actually I would go one step further. Following the FTX collapse, the probability that we're going to start seeing a wall get built between exchange and custodian, I think, is high. So now you've got Coinbase. Coinbase custody may actually need to be severed off as a whole different business. And Coinbase custody, like BitGo or Prime Trust, those entities will custody coins. The exchange just interfaces and accesses them. So you're separating those powers. Now, that means that you're going to get Ethereum ETFs, which are all going to have coins at the same custodian. Like that security mindset is going to be a further centralizing force. Now, where I think a lot of Bitcoiners get it wrong is that just having all of that stake doesn't necessarily give you control over governance, right? Because it still remains the governance of the hard forks and things is a bit more nuanced, but then you bring in the stablecoin problem that we discussed before. So the real risk, the actual real risk here is the centralization of block production and construction. So this is where MEV comes in, which stands for maximum extractable value. Used to be minor extractable value, but it's maximum now. Basically, if imagine all of your Bitcoin miners were one entity, they can choose that transaction over there. OFAC or the government has told me don't mine that transaction. So if all of your blocks are being produced by the same guy, then your censorship will be 100%. As soon as they say we're blacklisting that transaction, it's done. Can't get it in. If one miner is still out there operating and they mine 1% of the blocks, well, every 100 blocks, that guy might get his transaction in, but he's got to pay a higher and higher fee. So because basically you've got two pools of block space. You've got the compliant censored block space and you've got the uncompliant rebel block space. Now, what has happened is they've got this thing called, and again, it's a feature of Ethereum is it's quite complex. There's lots of layers to this. They've got a thing called flash bots, or it's basically there's a general term, but basically someone else builds the block. And these guys are specialists, right? This is the node that builds the block. What they're doing is they're looking at Uniswap trades and they're going, hang on, we can front run that transaction. They're looking at someone who's getting liquidated over there. We can slot ourselves in. Because remember, a block is a piece of code. It runs linearly from top to bottom. If I execute this transaction before this one and then run this one and you order them in a certain way, you can extract extra money out of the system, right? So it's basically taking a tax, so to speak, on usage. Now, that's a very specialized role. Little Timmy ain't going to do it. Coinbase might do it, probably won't, because they can now delegate to someone else. So the blocks are being largely produced by less and less entities, Flashbots being one of them, and that particular entity is the most profitable because the better you get at this, the more specialized you get, the more money you make,
right.
The more Coinbase can lift their APR button, and Coinbase is now more competitive than Binance. Customers go to Coinbase. So what you end up with is a system where you're going to get very few staking providers, which is the expected result for convenience. You've got specialization in the block production space, which is MEV. That is a centralizing force. And you know, if there's a website probably people seen with the red and the green bars, you can see that a large proportion of these blocks are now being produced by OFAC compliant systems. And you just have to ask yourself, if you were Brian Armstrong at Coinbase with the US government peering over your shoulder every single day, doing And it's not even about the fact that, like, if you chose to not use the OFAC compliant one, it's not even that what you want to do, even if they're less profitable. Imagine telling the US government that you chose to ignore their sanctions deliberately. No, you're going to pick the OFAC compliant one. So if you believe that exchanges are going to be regulated, if you believe that little Timmy wants convenience and risk delegation, then the probability is that block space of rebel scum is going to continue to shrink and shrink and shrink until there's just, people are not going to wait 6 months. And again, most of us aren't OFAC censored, but what if we are, right? You just start to see this game theory run forward, and then you add in USDC, being able to choose fork choice. You're like, man, there's a lot of layers that are hard to come back from. That's the problem.
Yeah.
The cloud is just someone else's computer. Everything you do online is intermediated and permissioned. Your data is not yours. Opt out by running a private server and take back control over your digital life. Until now, running a private server has only been available to the technical and the wealthy. The team at Start9 has developed an operating system called Embassy OS that levels the playing field and makes it possible for everyone else. Run a Bitcoin node, run a Lightning node, and become your own everything. Embassy OS is the distribution platform open source software has been waiting for. You can download Embassy OS for free and install it on your own hardware. Or you can buy one of Start9's plug-and-play devices. They build reliable products backed up with incredible customer support. Visit start9.com.
The BCB podcast is sponsored by Capital Logistics. Capital Logistics is a freight broker connecting truck drivers and shipping partners around North America. A true blue-collar business that supports blue-collar Bitcoin. They specialize in temperature-controlled cargo, efficiently hauling food, supplies, and other freight nationwide for some of America's largest companies. Capital Logistics is a firm believer that people and businesses should be able to save what they earn without having their purchasing power manipulated by the financial system, ravaged by inflation and currency debasement. As early adopters of innovative systems throughout their business, Capital's excess cash flow is put into Bitcoin every month. If you're someone that wants to work with a company that shares blue-collar values and an affinity for Bitcoin, reach out to Capital Logistics today. Find them online at capitallogisticsllc.com. That's capitallogisticsllc.com.
Yeah. I think a point worth making at this juncture, Checkmate, is that magnificent, cool, decentralized protocols can become functionally completely centralized. I mean, to zoom outside of crypto, let's think of SMTP, like the Simple Mail Transfer Protocol. It might have been, quote unquote, pristine and decentralized at one point. It no longer is. We explored this with Matt Hill when he was on here recently. And to get back to nodes, because, yeah, maybe it's oversimplified, but it's an incredibly important place to start when we contemplate the meaning and significance of decentralization. And it really comes down to how thin is the hardware spread. Back to the SMTP example. And if we're just picking on Ethereum as one example, and there's many examples, there's much more low-hanging fruit. If we talked about Solana, it'd be easier to blow this thing sky high. But comparing the difficulty that you just walked us through of running an Ethereum node and then juxtaposing that with running a Bitcoin node, for listeners that aren't running a Bitcoin node, I mean, it's startlingly easy, as you already hinted at. I mean, the Raspberry Pis are way more expensive than when we spun them up, but we spent $150 on hardware. We're using Start9 now. You can flash this thing on here, basically set go, and it's up and running with, for me at least, based on the device I've been running, almost perfect uptime.
It's an SD flash. That's it. Plug in.
Totally doable for a firefighter, right? And when we think through the implications of, back to the whole money discussion, right? And I love this phrase by Joe Carlasare, because we asked him, I don't know, months ago when he was on here, are you a maximalist, right? And he said, I'm a Bitcoin money maximalist. And I totally, when we're having a conversation about rewriting the fundamentals of base layer value transfer of Homo sapien, you're going to need a protocol with hardware spread thin that can remain robustly decentralized, not for years, not for decades, potentially centuries. Start asking yourself, can my protocol accomplish that? And if the answer is no, that's probably not going to be the long-term solution for money.
And this is actually, of all the things, this is probably the single most important point. Because even though some of the things I've said are critical of Ethereum, I still believe it's going to exist for a long time. And the important nuance here is that right tool, right job. It is not the right tool for base layer money. It's just not. What it is I can't say the best or the right tool, but certainly a more correct tool. Bitcoin is not very good for Uniswap. It's not very good for Compound. In fact, it's horrible at both of those things. Ethereum's great for it, right? So even then, there's scalability challenges and blah, blah, blah. But if your weakest link is your centralized stablecoin, you don't need Bitcoin security. You just don't. You don't need Bitcoin's level of decentralization because your whole attack vector is USDC. So I think this is actually a narrative that I maybe suspect will take a bit of root. I think it's going to be very uncomfortable for a lot of Ethereans, but essentially accepting that a level of centralization is actually okay. I think Lyn Alden has actually also postulated this. The concept is that Ethereum can go much more down the compliant, basically if they allow a little bit of capture and they actually give it to the US government in, private enterprise and whatever else and allow them to do their thing, price of this thing's going to go to the moon, right? Yeah. There's no question. And that's fine. That as an investment, good for you. What you're essentially investing in is something that's just not going to be as decentralized. And my honest view is I think the ship has sailed for recovery on this because there's just too many layers. In fact, there's only one way that they actually solve the centralization, decentralization problem. They need to have a governance fork that USDC wants to implement that the community doesn't, and they must rebel off. That's the only way. They have to rebel off, and it will be nuclear. It would be the equivalent of Bitcoin changing the ASIC algorithm. That's essentially the scale of it. That's, I think, the only way. If they did that, there's no question. Rebel Ethereum will return to being a more decentralized system. Just don't think it's going to survive is the problem.
I think we'd be remiss if we didn't swing this back to Bitcoin before we finish up. And we would not want to let Bitcoin necessarily off the hook easy. I mean, we've beaten up ETH, kind of given it a hard time, which it does deserve. I don't think any of us want to see people failing overall, although we do want Bitcoin to succeed. Ethereum does position itself and does have some interesting features that definitely could be used in the future. And watching it become a centralized entity, watching it basically turn into the system that it has been created to disseminate itself from is very disappointing, I think, for people that are actually, pro freedom and pro decentralization in the world.
100%.
As far as Bitcoin is concerned, though, let's do a little bit of Steelmanning and talk about what are some of the viable risks that you see for Bitcoin in the near future, especially after this whole FTX blow up. We're going to see a lot more politicians trying to get their hands and regulate anything and everything they can. Elizabeth Warren is hot to trot right now, and she wants heads to roll.
I saw a good tweet about Elizabeth Warren. Actually, I can't remember what the numbers are, but she's put forward like 300 bills and has like 2 of them that's ever got passed. So her hit rate's like 0.16% or something. Anyway, no, and I think this is something that Bitcoiners need to do a lot more of. Is actually looking at the fallbacks and the pitfalls. So there's a couple of things that I've got on my radar. One is the risk to self-custody, right? A 6102 type event, which I think is going to be a hot button issue, right? So there is the you can no longer self-custody. And I think that's extremely dangerous. I would put that into the way I describe that. It's the goldification of Bitcoin, which we got a flavor of that. What happens if your paper derivatives get so large? And we mentioned the scam pump before. There's no question that a big reason we didn't get higher is because there was too many people speculating on not just derivatives and futures, but also altcoins, right? That sucks money away. Speculative capital comes away from BTC, rightly or wrongly. So there's that risk. The other one, which is kind of in tandem with that, is the privacy element. Bitcoin has really, really piss poor privacy. There are tools. There are the Wasabis and the Whirlpools and join markets. How many people use it?
It's bad. It's really hard to stay private on Bitcoin. Just as a regular bloke, I'm going to admit it. It's really challenging. Josh and I talk about this a lot.
Yeah, and the risk is
challenging not only because it's not challenging to do it. To do like say Whirlpool on Sparrow, very simple. The problem is not doxing yourself in the future. Because if you ever mix that with some other Bitcoin that you bought KYC'd, the whole thing is fucked. You might as well have not bothered.
And further to that, I think probably the biggest hang up is just the looming threat of, if I mix this, I can't sell it. That right there, that's the kill shot. So then, and you kind of step down these risks, right? And this is what Ethereum does a little bit better than us, right? In the event where you have an FTX, in the event where you have a black market requirement, right, where the world kind of says, sorry, no more self-custody, privacy is, you can't do this, that, and the other, which Tornado Cash gives you a bit of a flavor of. There's all these things where you could go down this path. Ethereum, you would still be able to withdraw your coins, borrow money, move it around the system. The challenge is that USDC could say, sorry, we're going to block that transaction. But you could still, you'd have more mobility. Let's say. Bitcoin, you're a lot more limited. We have very, very few decentralized exchange options. We have but again, what are you swapping in and out of? That's kind of the problem. So in many ways, it's kind of the same risk that gold went down, which is that we just turned Bitcoin into another fiat currency, right? Gold is essentially just another fiat because it trades with mostly paper derivatives. And if you ever want to get it, it's, your GLD ETF. People don't bury gold coins in their backyard. Much, much easier to put coins in your backyard. But if we don't have that somewhat decentralized or at least systems that can allow us to be more flexible and transact peer-to-peer, that's really the risk. Now, there's certain options there, like, you've got things like RSK, and there's the concept of drive chains and things like that. I think what I like about any one of those solutions, or multiple of them, ZK, what I call ZK rollups and things, there was a paper written on that recently. There's trade-offs in the sense that it will potentially introduce a bit of MEV, but what you want to do is push all of that computation, all of the Ethereum stuff. You want it to be somewhere that can just get chopped off, blown up, go to zero, and Bitcoin keeps chugging along. Yes. So whatever you do, don't impact the base layer to the point where it's irrecoverable. But I think we should be, as a community, pushing that stuff away, but to a layer, and actually promoting the innovation. Because the thing is, a lot of people may not see what comes out of it. We may just solve some of these problems, and people are going to say, oh, it's not decentralized. But we've just discussed that Ethereum is able to build this stuff. It's not as decentralized, but that's just fine because your base layer is the stablecoin anyway. So be as decentralized as the stablecoin.
Yeah, this is such a key thing, though, for someone that's newer to the space. It's that for the main Bitcoin value proposition and the truly catastrophic bullish scenario for Bitcoin to play out, and that's, as we alluded to, rewriting how money works, that base layer has to stay totally immutable, completely decentralized, and it needs to be able to run on a node in a firefighter's basement, right? And for those things to be true, that means that base layer, that protocol, has serious limitations, which we just picked at, which means there's been a lot of, but there needs to continue to be more of, significant innovation, which in some senses you could say, at least for me in the 5 years I've been in, I could, in some regards, if I'm being critical, say is lacking. I'm encouraged to see more venture capital funding coming into Bitcoin only, but this is something we need to keep harping on because the protocol stack needs to grow and fill out for this thing to fill in some of these holes that are real.
I don't know if I completely agree with you on that. I think compared to when we started in 2017, Lightning Network was basically 3 nodes connected to each other in 2017. It is now thousands of nodes. And we have things like Taproot that are coming on around, and second, third, tertiary layers, Fediment coming online too, that allows a lot more. It's a more centralized system, but it's a layer on top that allows people to be more, anonymous as far as their transactions are concerned. So, yeah, I do wish there was more money and more movement on this, but there certainly is movement in the right direction from my perspective.
Yeah, I agree. I'm just saying, when you think about the amount of capital, companies, efforts put in the quote unquote crypto space, and then you factor in how much of that's actually happened on Bitcoin, if I'm being critical, it pales in comparison. And
yeah, but there's a lot
all
less,
those things
there's
are
a lot
encouraging,
less
but
suckers to be screwed on Bitcoin than there is in all these other cryptos.
Yeah.
And actually, I'd even bring it back to another point here. So there's, when you look at the Ethereum stack, right, which is kind of our best case study for what you can build, how much of that stuff is going to stick around, right? How much of it is actually in demand and useful? And personally, when I kind of strip back all the onions and I look at what is actually the most useful stuff, and being someone who's used quite a lot of it, really, there's kind of 3 buckets of things that I found to be useful that would actually, could be built somewhere on Bitcoin. The first one is something like a Uniswap, right? Just a very, very simple automated market maker. Now, that design can be built using other methods. Lightning Network is maybe, because it's still channels going in, but it's kind of going to be a, what would you describe it as? Almost like a decentralized BitMEX, right? There's solutions where you can have Bitcoin as the central liquidity. You could send, for example, it will be centralized in the sense that you need the same clearing houses and all that. But imagine if you could send Apple stock and out comes Turkish lira on the other side of the world, right? A giant liquidity pool that's kind of what Jack Mallers is doing. So there is that element, but we accept that there's that centralization. There's things like Compound, which is that money market type fund, right? The repo market is essentially what Compound is. Banks put their securities in and they borrow dollars. Banks put their dollars in and they take back securities, right? So Compound is essentially what the repo market is. Probably not useful that much for the average punter. Very, very useful for the big banks. So I can see all that kind of stuff getting built out as infrastructure. And the other one is, oh, no, actually, I've forgotten what the other one was. But anyway, they're kind of the 2 that at least stand out to me. Automation of just general finance. So, for example, you've got like an ETF, right? We've seen many of these index products get built on an Ethereum, right? It's going down the path of like security tokenization. That, I think, is probably going to be a thing. We're probably going to see clearinghouses get built using blockchain technology. Will the average punter need to be using his own wallet to interact with it? Probably not. Most of this stuff will probably be interbank back-end type work. They're kind of some of the things I can see being built and useful. But for the most part, and actually you can see this in the data. I've been poking around a lot of our Ethereum data of late. And actually we put out a paper when we released some of these metrics. Imagine like a 0 to 100%. How much of Ethereum transactions or gas consumption was DeFi, NFTs, stablecoins, ETH transfers, blah, blah, blah. And what you see is these like, ERC20s blow up in 2017 and then evaporate to nothing. DeFi blows up in 2020, evaporates down to not much. Stablecoins, very consistent base. Always there, just continuing to do their job. Vanilla ETH transactions, NFTs, massive peak, 38% of all gas, now back down to like 8%. So you see these booms and busts of innovation, but so far, stablecoins is actually the only one that's kind of stuck the test of time. And, they're 3 of the top 6 assets in the space. So you can see those demand vectors building out.
As we round this out, I want to hear you. I know during the video, you talked a little bit about how you have structured your crypto portfolio. What percentage of your holdings are Bitcoin versus Ethereum and any assorted other altcoins you're interested in? Just curious on how much resolve you have in Bitcoin versus everything else.
So essentially, when you give me ETH BTC at 0.08, I'm taking it all. So I'm fully divested from ETH at this point in time.
Gotcha.
Basically, when I saw the response to the video, what I basically saw is that there was no interest. I mean, there's certain podcasts out there that would have been the right place to have actually talked about it. Just, again, even if I'm dead wrong, please, someone just blow me out of the water. Nothing would have appeased me more than for someone to have essentially said, every single point is wrong and here's why. And I basically got nothing. So, there's podcasts out there that would debate a catfish on anything it had to say, and it just wouldn't touch it. So when a lot of the responses that I got were, I've never thought about this. That's like, thank you for giving me that view. And there was others who were just like, you're just a fucking crook. There was no rebuttal to the argument. It was all ad hominem. So when I kind of looked at that and I saw the response, I thought, all right, I gut feel tells me I'm probably more right than wrong here. Again, more than happy to hear any kind of rebuttal that just blows it out of the water. But it was kind of the final nail. I told you I was flip-flopping for many, many years. I basically saw that there was actually no desire to change it. So at that point in time, bang, goes from a potential to purely a price trade. So essentially, Rodolfo were like this, my cold card is essentially 100%.
Beautiful.
Love it.
Now, what I will say though, and this is what Bitcoiners don't talk about, the Ethereum trade was by far the easiest way for me to stack sats. So that's the other thing, is that its outperformance, you have to give it that credit. And I've been talking about Bitcoin dominance of late. You know, people like to use the trading view version. Don't use the trading view version. It's dog shit. Absolutely wrong. When you look, the right way to look at Bitcoin dominance is using realized cap, right? Value every coin when they last moved. That means that Ripple, when they pre-mine 100% of their coins, they've never moved. They're in escrow, so they have a price of 0. So you have to value every coin at the price when it moves, because that's a buy and a sell as best as we can measure it. When you plot out dominance in terms of realized cap, you may have seen Willy Woo's been posting his chart where it shows all the coins are just smear down to 0. You essentially get to see that. There's Bitcoin, which is growing in dominance since the 2017 peak. And there's Ethereum, which has essentially gained a market share of about 20% and held it. So even within that context, of all of the assets that exist, basically Bitcoin and Ethereum are the only two that have a genuine, sustained user base. They're probably both going to exist, whether you like it or not. The trick is to learn from one side rather than just say it's a scam. The mission is actually to look at what they do well, look at what they don't do so well, and build your arguments accordingly.
Yeah, we resonate with that point of view quite well. Like, even though neither of us own ETH, like we want to at least understand it, have somebody on that can have a pretty decent way to impart what it's doing and what it's trying to do, and how, you know, useful as an idea or as a investment as, you know, we can find out about.
Indoctrination and cults are built in environments where you tell people what they're not allowed to go explore and learn about.
100%.
We're not here to pump Ethereum, but if you're around other maxis that tell you you're not allowed to go learn about Ethereum, tell them to go fuck themselves, because that's the whole part of intellectual integrity. The things you disagree with even the most in life should be some of the things you pay most attention to, and that you seek out the most thoughtful thinkers on that side of the argument. And that's what the whole journey is about. So if
there's no way that I would have the level of detail that I know about Ethereum if I didn't use it for years. It's the only way you can ever do it. Like, experience is everything.
Yeah, we've made a couple good observations about DeFi in general, and critique any of this if I'm not characterizing it right. But a lot of what you just said is that DeFi's got some limitations, right? And one thing I think of, back to this Lyn article I just read, is that a lot of current DeFi, right, let's say in the Ethereum ecosystem, is a centralized product whose liabilities are bare assets, right? But the thing at the base of it is a centralized, say, stable coin. If we're kind of, maybe that's a bit of a straw man. Or at its most dark, it's reliant on pump and dump, completely useless tokens. What you've sort of insinuated is that there's already being built, and there's room to build decentralized finance with base collateral and liquidity that's actually decentralized, and on top of a protocol such that you don't need your own token. I know that word's gotten like dirty. There are better ways to do it. There is a path forward that doesn't involve this degree of clownsmanship that we've seen over the last year with all these implosions.
Yeah, and this is, I think this is important, something I've certainly learned, particularly over probably the last year. And you guys have probably seen it. How many Bitcoin podcasts are now talking about, you know, mining, and how proof of work energy, the actual physical imposition that Bitcoin has on the world, has actual positive externalities on the physical world, right? There's the proof of stake side, which pretty much it's entirely internal. Everything happens internally. There's not an external. People have to literally pull fiat out of that system for it to have a positive externality. And this is something I've learned about Bitcoin recently, is we don't do tokens, right? That's a funding mechanism. And I saw a great tweet by, I think it was James Presswich, who's a very, very accomplished developer in Ethereum, or also Bitcoin. So he basically said that a token is something you do when you don't need to generate a business model, right? Generating a business model and making revenue is hard. If you issue a token, you no longer need to do that. You've essentially got your money. So the trade-off there is, how do you fund work, right? We have to keep saying, you know, you got to donate to Bitcoin Core developers. Now, that's great because it maintains decentralization. It becomes a passion project rather than a commercial thing. You remove the reliance on VCs, but you get less innovation, right? So there's less money flowing in. So the trade-off there is in the funding side of things. But when I look at the difference in psychology, this is something that clicked recently, is that Bitcoin improves people's meat space businesses. It improves our power distribution. It improves things in the real world, right? It's a base level that when people choose to operate on a Bitcoin standard, it changes their mindset. It changes the way that they behave. It changes their finances. That's the difference. The Ethereum ecosystem is investing VC money to build stuff in the internal system, and that's generally manifested as a stock or a token. In the external world, Bitcoin is actually manifesting as physical representations of what sound money achieves. And I think that's a really important distinction in that it's actually creating businesses external, and you can't map that on chain because it's not happening on chain. Bitcoin changed my life and the way that I look at things for the better. And I'm sure there's many, many people who have the same opinion. You see these mining farms setting up actual dams that power places in Africa. You can't do that with proof of stake. It's just not a thing. So
gridless.
That, exactly.
They're literally doing that right now.
Powerful. That's
And
where I
back
think
to
the narrative needs to go.
Back to the Oracle problem we discussed. Like, where's truth coming from in the digital realm and within the protocol? And Bitcoin stands alone because it's tethered to unforgeable costliness, real world energy.
Right.
Exactly.
And that's just a point that
second
burns
system
deeper
syndrome,
year
right?
over
It's
year
so
for me,
simple.
man.
It's so simple that every protocol that tries to replicate it just adds complexity and complexity and complexity, but they can't solve it because it was already solved.
Right. God, I think that last 5-minute rant you just went on there was stellar, man. That's certainly going to be at least part of that. It's going to be the intro for this. I can't think of a better place to end it after hearing that either. So
yeah,
thank you for joining us.
I've got like 8 more things I want to pick your brain on, but we're going to cut it at an hour and a half. This was stellar. Checkmate. Loved it.
Round 2.
Can you give us a handoff to yourself, who you are, what you do, where we can find you?
Yeah, for sure. So you'll find me on Twitter at @_Checkmatey. Checkmate was taken, unfortunately. Now, in terms of like, if I was to give you a handoff on things to do, my view is that on-chain analytics gives the average pleb tools that they just never had, right? You can visualize, learn about Bitcoin, understand how it works. And, you know, if you're in the dollar cost average camp, as we were talking about before, there is edge that you can find being in the right place to dollar cost average and being in the right place to dollar cost exit, right? There's tools you can do to actually make your stack larger. And a lot of them are really simple. So what we're really trying to do, and me and my guys at Glassnode are trying to do, is make these things super accessible. And we're putting them into, our big project recently has been dashboards. And the logic here is that there's like the right tool for the right job. You'll hear me say this a lot. We're trying to build the tools with the guidance so that you know when this happens, I'm going to go and check it out on this particular dashboard. So we're trying to give the plebs the tools that they need to essentially solve the problems that Bitcoin throws at you.
All right, go get the kite out, man. Stay careful out there. We need you on for round 2 as well.
Totally.
Need some,
looking forward to
some
it.
videos, man. Get a GoPro on your head. We want to see it.
I'm contemplating getting the GoPro, actually. It's one of those things I'm like, Christmas is coming up. Maybe I'll treat myself.
Yeah, do it.
Thanks,
all right, man. It was a pleasure. Thank you.
Nice one, fellas. Pleasure.
Take care.